What's up, team? Welcome back. Today we're diving into Dan Ives' latest take on the market, and it's a big one. He's calling it an AI arms race, and his message is crystal clear. If you're building in AI, you're going to have to pay up for top-tier talent. We'll unpack why that matters for margins, product velocity, and which stocks actually benefit when companies choose speed over savings. In the same interview, Ives points to stronger than expected iPhone demand powering Apple's next upgrade cycle, yes, even after a muted iPhone 16, and he stays constructive on EVs with Tesla as the big global winner, while BYD remains a force in China. In other words, hardware momentum, AI acceleration, and selective EV strength are setting the tone for the next leg of this market. Here's the plan for the video. First, I'll roll the CNBC clip so you can hear Ives in his own words. Then I'll break it down. What AI arms race really means for hiring, R&D budgets, and product roadmaps, why iPhone 17 demand could surprise Wall Street, and how I'm thinking about positioning around the EV landscape. After that, I'll give you my in-depth analysis of 2 AI stocks to buy now based on these signals. If you only watch one video today, make it this one, and watch it through to the end so you don't miss the stock picks and my game plan. Smash that like button, let's hit 1,000 likes, share this with someone who needs a clear take on AI and Apple right now, and drop your thoughts in the comments. And of course, subscribe so you never miss the next big move in markets. Alright, let's hear what Dan Ives has to say.
In a note to clients yesterday, Wedbush's Dan Ives wrote his firm is tracking shipping times, that he's seeing particularly strong demand for iPhone 17 Pro models, which is a positive sign for Apple. Dan Ives also hiked his price target to $310 a share, one of the highest on the street. And we're joined by Dan Ives right now to discuss what he's seeing in Apple right now. Your old price target we just showed at about $270. By the way, the street's at about $272, right around there, the consensus. What are you seeing that the rest of your peers just aren't seeing?
Surprise upgrade cycle. I mean, look, coming in here, we thought scale of 110 is going to be about an 8.5. The Pro models, I mean, we're seeing actually massive demand in terms of online as well as in the stores. ASPs are going to see an uplift as well. So you combine this with 315 million have not upgraded their phones in 4 years. This is finally, I think, the upgrade cycle the streets hoped for the last few years.
Wait, I want to correct myself. The street's at about 247. So you're considerably more bullish.
Coming up. I think.
Okay, you think it's actively coming up. But either way, you're considerably more bullish than everybody else. What makes this time around different? Now, I will admit that we saw reports from London and from China, Chinese consumers lining up to get the iPhone, even though it doesn't have a lot of the features that they have in their domestic phones, like foldable and AI features and things like that. Why is this so different this time around from the 16, where demand was kind of muted? I remember we had our reporter, Steve Kovac, outside the Apple store for the 16. Nobody's lining up.
Yeah, look, 16 was disappointment. And I think to some extent, that disappointment now, combined with some model changes, is leading to what...
But what is it? What's different this time around? Longer battery life? Is it the live translation and the AirPods? Like, what's getting people so excited?
Look, I think the surprise is going to be the Air. I mean, if you look at iPhone Air, that's going to be, I think, the star of this show, and especially in the U.S. I mean, I saw in the stores over the weekend, Frank, 3 of every 10 were coming in for the Air. So in terms of some of the model changes. And then you think about China, because of regulatory, that's still not even on sale. So I think we could be looking at what could be 240, 250 million units. Street was about 230 million. So I think as that comes through, this could push Apple $4 trillion market cap.
All right, while we have you here, I also want to talk to you about the new H-1B visa news. We kind of touched on some of the companies that are most impacted, Amazon, Goldman Sachs, a number of big firms that a lot of people know. In general, this policy, how do you see it impacting the broader tech sector? We had a guest on just a short time ago, the CEO of Payoneer. He believes it's going to really impact scaling companies. What do you see as the impact to the tech sector?
Yeah, it was a great interview. Look, the reality is tech companies, I mean, backs against the wall because they're going to have to pay up for that in terms of some of the talent outside HB1. Look, the issue is, if you want to hire an engineer, 800,000 or 150,000. So, I mean, this has really been the opportunity for them to get cheaper, labor. But I think the reality is that they're going to have to go more, toward U.S. workers, given some of the cost structure. But for tech, it's an arms race right now. And in this AI arms race, they don't have time to basically go to the whiteboard. So you're going to have to see them pay up pretty significantly in Silicon Valley.
We're looking at Indian IT companies under quite a bit of pressure, down about 3 1/3 to almost 5%, just across the board, looking at some of those names. Before we let you go, we got to talk to you about the EV sector. We saw Berkshire Hathaway sell its stake of BYD. It was one of the leaders in investing in BYD. Does that change the investability of the not only Chinese tech sector, but Chinese EVs?
Look, I think BYD has been obviously a phenomenal play for them. Look, competition's increasing, and we've seen from the Tesla perspective as well. But I do actually believe that's a sector that's actually still going to be extremely strong. I mean, competition's increasing.
Strong sales or strong margins and strong profit, because they clearly compete on price.
No doubt. But if you look at overall demand, I mean, it's gone through a soft spot. But I think when you look at the next few years, you're going to see 20-30% conversion in China. I continue to think the bigger winner is going to be Tesla. BYD is going to be a clear winner as well. That's in the amount we're bullish on.
But when you see a big name like Berkshire Hathaway pull out of that stock, it's obviously putting some pressure on the entire Chinese EV sector. Does that change the view of it? We had a conversation earlier about Chinese tech stocks and the Chinese market in general. Is it now investable after thoughts before that it wasn't? Does this move, does it change the view of Chinese EVs? Because we saw a similar move when Berkshire Hathaway got into healthcare. That made people feel a lot more positive about healthcare.
Yeah, look, when they talk, they make a move everyone's going to watch for good reason. But I do think, look, a lot of this is just U.S.-China negotiations in terms of trade, what that means. Frank, I think if you see much more positives in terms of this, you're actually going to see U.S. investors focused a lot more on Chinese players. It's still a bit of caution when it comes to BYD and others, and that's why when Berkshire did here, I think sends a little bit of a signal that will show some caution.
Let's start with Apple, because that's where the most immediate signal sits. Ives is effectively calling a surprise upgrade cycle. His team at Wedbush is tracking shipping times and in-store traffic and, in his words, seeing massive demand, especially for the Pro tier. That matters because Pro Mix drives average selling prices higher and flows straight into revenue leverage. His thesis rests on a pent-up cohort, roughly 315 million iPhone users who haven't upgraded in about 4 years. Whether you believe that exact number or not, the concept is right. A very large installed base has been sitting on older devices, and if the product and pricing line up just enough, you get an outsized refresh. He raised his price target to 310, well ahead of a street consensus he characterized as still catching up. The mechanism behind that call isn't exotic. Stronger than expected unit volumes plus a richer Pro mix equals top-line acceleration and better margins. He even put rough unit bookends around it, 240 to 250 million iPhones versus the street sitting closer to 230 million. If anything close to that comes through, it forces estimate revisions and re-ratings. Now, what's actually different this time? The hosts pressed him on that because the iPhone 16 cycle underwhelmed, with obligatory Apple Store line shots that looked frankly sparse. Ives' answer is more behavioral than feature-driven. Disappointment last cycle, plus some meaningful model tweaks this cycle, plus pent-up demand equals sign of pop. He does nod at features, battery life, live translation, AirPods tie-ins, but you'll notice he doesn't anchor to any single spec. The star, he says, could be the iPhone Air, particularly in the US, based on what he saw in stores over the weekend, where he claimed roughly 3 out of 10 walk-ins were there for that model. Whether you love that branding or not, the point is product segmentation. Apple is creating another just right rung on the ladder to catch upgraders who won't pay Pro prices but want a fresh experience. He also flags a China wrinkle. Regulatory delays mean some models aren't even on sale there yet. That's important. If China demand is deferred rather than destroyed, you can see a second-wave tailwind when approvals clear. It's a reminder that near-term data points, empty lines, staggered launches, can mislead you about the full-cycle impact. My take, this is a classic Apple narrative turn. Sentiment got dulled by a ho-hum prior cycle, the consensus shifted to show me, and now the early read-through on mix and cues hints at upside. If you're modeling, the levers to focus on are 1. Pro mix, 2. Carrier promos that lower effective prices without crushing Apple's realized price, and 3. Any services attached that rides the hardware lift. If Wedbush is even directionally right on units, the next 2 quarters could see estimates creep higher. The risk? That the early demand is front-loaded enthusiasts and doesn't sustain once the first wave's clear, or that macro in Europe-China pinches the back half. But Ives is planting a flag that the hoped-for upgrade wave is actually materializing. Shift to the H-1B visa news. The interview pivots to how policy changes affect tech hiring. Ives' framing is blunt. This puts big tech and scaling tech in a bind. If it's harder or more expensive to bring in talent under H-1B, companies pay up domestically, and they have to do it fast because we're in an AI arms race. No time to go to the whiteboard, as he puts it. Translation. Projects can't slip, model training cycles and product roadmaps are relentless. The cost of delay dwarfs the cost of higher comp. Practically, that means two things for investors. First, you'll likely see upward pressure on R&D and OPEX lines, especially at mid-caps that don't have the same recruiting magnets as the hyperscalers. Second, this favors companies with talent moats, those with established research cultures, strong immigration legal muscle, and internal training pipelines. It's not a thesis killer for AI plays, it's a margin volatility reminder. In a world where speed matters more than ever, the winners will eat that cost and keep shipping. My view? Watch management tone on hiring in the next couple of earnings calls. If you hear, we're paying more to keep velocity, that's bullish on product cadence, even if it pressures margins near term. If you hear, we're slowing hiring while we reassess policy impacts, that's a yellow flag on execution speed. Also keep an eye on outsourcing dynamics. Some companies will increase nearshore and offshore contracting as a bridge, but the sensitive AI work tends to stay in-house. Now, the EV segment. Berkshire Hathaway's exit from BYD is the headline catalyst. The knee-jerk read is, if Berkshire taps out, what does that say about Chinese EVs? Ives' take is more measured. He credits BYD as a phenomenal trade but underscores that competition has intensified, pricing is fierce, and demand hit a soft patch, but he still expects strong sector growth ahead, calling for 20-30% EV conversion in China over the next few years. Crucially, he positions Tesla as the bigger winner while acknowledging BYD remains a clear winner in China. That duality is important. It's not Tesla or BYD, it's Tesla and BYD with different edges, Tesla in brand, software, and global margin mix. BYD in vertical integration and domestic scale. The other undercurrent he highlights is US-China trade sentiment. He basically says investor appetite for Chinese tech and EVs waxes and wanes with trade optics. If headlines warm, capital warms. If headlines chill, capital retrenches. Berkshire moving out undeniably pressures sentiment in the short term. Institutions pay attention to that signal. But Ives stopped short of calling it a structural red light on the category. He frames it as a context shift. Proceed with caution, recognize the policy beta, and differentiate between domestic China champions and export-exposed names. Here's how I'd translate that into an investing framework after the interview. For Apple, track the mix. If pro lead times stay extended relative to base models, and if carriers keep subsidizing upgrades aggressively, this cycle can surprise to the upside. Also, watch for China release normalization. A delayed start can become a mid-cycle booster. Ives' 240-250 million unit bracket would be a clear beat versus a 230 million setup. If realized, it likely pushes estimates and supports his higher target. I'd fade hand-wringing about lines outside stores. The more reliable signals are supply constraints on higher-end SKUs and the cadence of backorder reductions. For AI-heavy tech broadly under H-1B constraints, expect OPEX creep and don't panic if you see short-term margin pressure in exchange for execution speed. Favor names that repeatedly demonstrate they can recruit and retain Tier 1 talent. The opportunity cost of slowing in this phase of AI platform build-out is higher than the incremental payroll dollars. For EVs, separate near-term sentiment shock from long-term S-curve math. Berkshire's BYD sale dents confidence, but the structural EV adoption story in China remains intact, and price competition, while painful, often drives volume. If you're Tesla-centric, Ives' stance supports the view that Tesla remains the global bellwether, even as Chinese competition crowds the low to mid-tiers. If you're China-exposed, you need to be paid for the policy risk. Position sizing and time horizon matter more than ever. A couple of caveats I'm adding because they're important to keep us honest. First, when analysts call a surprise upgrade cycle, the risk is that early demand reflects superfans and subsidy windows, not the median buyer. If we see order momentum fade after the first month and the mix normalizes towards non-pro, the math changes quickly. Second, with H-1B, companies will try to backfill with contractors and automation. That can work on infrastructure and tooling, but it's not a one-for-one replacement for core research engineers. Expect execution dispersion, some will handle this transition much better than others. Third, on EVs, price cuts can buy unit growth but compress profit pools. Watch the balance between volume and margin rather than headline delivery numbers alone. Bottom line, Ives is leaning pro-cycle on Apple, pragmatic but urgent on AI hiring, and constructive on EV adoption despite short-term Chinese volatility, with Tesla and BYD both framed as longer-term winners. From an investor's standpoint, I agree with the direction of travel on all three. My plan is to verify Apple's demand signals over the next few weeks, mix, lead times, carrier promos, while giving management teams some room on expenses if they're maintaining AI velocity. And in EVs, treat sentiment shocks as opportunities only if your thesis is truly multi-year and you can stomach policy-driven drawdowns. That's my read. If you found this breakdown useful, tap like, drop your questions in the comments and tell me where you agree or disagree on the Apple cycle, H-1B impacts, and the EV winners. Let's keep building conviction with data, not headlines. Now we'll dive into the 2 AI stocks to buy now and hold for the long term. Let's begin with Meta platforms, ticker Meta. Facebook, Instagram, and WhatsApp anchor a massive global ecosystem. Billions connect, watch, and shop across these platforms every day. Beyond social, Meta is building the next frontier with Reality Labs. AI sits at the center of Meta's mission, powering personalization and monetization. From newsfeed rankings to Reels recommendations and creator discovery, AI sharpens ad relevance, driving ROI for advertisers and revenue for Meta. It also fights spam, fakes, and harmful content at global scale. Meta has pioneered open-sourcing powerful language models like Llama, accelerating industry innovation. It's designing specialized AI chips and scaling data centers for colossal compute. Expect assistant-like features, planning events, smarter shopping, unlocking new engagement and revenue. Investing in Meta is owning a data-rich, AI-driven enterprise with a clear long-term vision. Scale creates a defensive moat, forward bets open new growth runways. Next, how AI becomes Meta's unstoppable engine. Personalization, retention, revenue. The flywheel spins faster as AI improves. Stronger recommendations and safer feeds make products stickier. Let's zoom into the engine. At Meta, AI isn't a side project, it's the central nervous system running everything. It decides which posts you see, which reels you binge, and who you follow. Better models, better ads, bigger budgets, a powerful flywheel. AI safeguards platforms, flagging harmful content, spam, and fakes. Open models like Llama attract talent and accelerate breakthroughs. Custom chips and massive data centers fuel training and deployment. Expect AI assistance and seamless in-app shopping to expand monetization. Today's AI spend seeds tomorrow's product suite and next decade's growth. A vision needs fuel. Meta's finances bring the horsepower. On to the numbers. Meta's ad business is a juggernaut. Immense revenue, high margins, strong free cash flow. Tens of billions in cash and securities deliver strategic flexibility. It funds long-term bets, metaverse, foundational AI, without risking the core. E-commerce and in-app shopping aim to keep transactions in platform. Creator tools, tipping, and subscriptions can add recurring revenue. Meta Platforms currently holds a massive market cap of $1.95 trillion. The company delivered earnings per share of $27.55 and trades at a price-to-earnings ratio of 28.25. In 2024, Meta generated $164.5 billion in revenue and posted a strong net income of $62.3 billion, showing the strength of its advertising model and continued push into AI and virtual reality. Over time, these levers diversify beyond ads, risks, regulation, privacy, content moderation, and ad cyclicality, but dominance, robust core cash flows, and aggressive AI investment underpin Meta's long-term case. Our second titan, Alphabet, ticker GOOGL, crown jewel Google search, the gateway to the internet for billions. Beyond search, YouTube, Android, Maps, and Google Cloud. Alphabet's AI roots run deep, publishing breakthroughs including transformer concepts. Strategy, infuse AI into search, YouTube, Maps, Gmail, and more. AI leadership monetizes through ads and enterprise AI via Google Cloud. Generative AI enables conversational answers beyond blue links, enhancing user value. YouTube's AI moderates content and powers sticky recommendations. Google Cloud wins with cutting-edge AI services for enterprises. Alphabet designs TPUs, specialized chips for large-scale AI. Hardware plus software co-optimization boosts efficiency and speed. Improvements ripple across ads, cloud, consumer devices, and more. Deep research plus massive deployment makes Alphabet a top long-term AI contender. Let's look at the financial backbone. Massive ad revenues across search, YouTube, and partner sites create reliable cash flow. Google Cloud is scaling fast, adding diversification and profitability. A mature cash cow plus a high-growth engine equals balance. Alphabet's fortress balance sheet funds AI, quantum research, and strategic M&A without heavy debt. Alphabet stands with a market cap of $3.08 trillion. Its earnings per share come in at $9.37, with a P/E ratio of 27.18, putting it in a similar valuation range to Meta. In 2024, Alphabet reported $350 billion in revenue and net income of $100.1 billion, driven by its dominance in search, YouTube, and cloud computing. Risks: global regulation, antitrust scrutiny, fierce cloud AI competition, and high AI infrastructure costs. Dominant positions, research depth, and financial strength support a compelling long-term thesis. Together, these numbers show just how dominant both Meta and Alphabet remain in the tech sector, not just in terms of scale, but in profitability and growth potential that continues to attract investors worldwide. Time for a quick sponsor that helps you invest smarter. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth with solid, undervalued stocks but not sure where to start, I built this course to help you identify great companies, make smart decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. I've just relaunched my Value Stocks Investing Master Course, principles inspired by Warren Buffett and Benjamin Graham, with real-world metrics, step-by-step lessons, and practical strategies. Whether you're starting out or sharpening your strategy, join today. Your future self will thank you. Want exclusive stock tips, in-depth analysis, real-time trade alerts, and free guides? Join the Stocks Galore Patreon, link in the description. Meta skews to social and ads with emerging commerce and VR. Google blends ads with a fast-growing cloud engine. Buy and hold doesn't mean buy at any price. Focus on growth, margins, and free cash flow. Which will lead AI over the next 5 years, Meta or Alphabet? Drop your take below. Don't forget to like, share, and subscribe for the next big update. Thanks for watching. See you in the next one.